This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on trading ranges. Just like channels can be tight or broad, trading ranges can also be tight or broad, and you trade them differently. I think it's important to look for early signs of what the market might be doing, and therefore traders have to be aware of the early signs that a trading range might be forming. Trading ranges can be very broad, they can be very tight. And when they're broad, as they are here, traders can buy for swings, they can sell for swings. They can also scalp. In general, once you think that the market's in a trading range, it's better to look to buy in the lower third and take quick profits, scalp, and sell in the upper third and take quick profits, scalp. A good way to do it is to buy reversals up from near the bottom of the range. This is the second entry for a failed breakout below this low. The first went above this bar, and then now we have a bull bar closing near its high. That's a higher probability entry. Here we have a micro double bottom. We went down on this bear bar. This bar has a bull body, so it went up. This bar has a bear body, so it went down. And now we're going up again. So a micro double bottom, buy above the bear bar or buy above the bull bar. And now we have a test of this low. So now we have a small double bottom. Traders will buy it reversal up. Entering with stops is a good way for traders to trade when they're starting out. In fact, it's the best way for them to trade when they're starting out. The opposite is true at the high. Traders will sell reversals down. A big bull bar late in a trend, an attempt to break above the top of the channel, likely to fail. Traders will sell a reversal down. Here we have an attempt to break out above a double top. Traders will sell a reversal down. This is not ideal because it's more in the middle third of the range. This is a better sell. Testing a prior high, reverse down with a good bear bar. And now there's another good sell signal bar, a bear bar closing near its low, good sized bear body. Traders will sell with a stop just below the low of that bear bar. Again here, 2 legs up, 1, pull back 2. In the top third of the range, traders will look to sell. Maybe not so much below this bull bar, but maybe below that bear bar, or maybe below this bear bar or that bear bar. Experienced traders will enter with limit orders, betting that reversal attempts will fail. For example, here we have 4 consecutive bull bars, all closing above their midpoints. Chances are this is a bad sell signal bar, and there'll be more buyers than sellers below the low of the bar. Traders will buy with a limit order at the low of that bar and get filled here. The bears are trying to get a breakout below a channel, just above a prior low. Every breakout attempt here reverses up within a bar or two. Chances are this breakout will reverse up as well. Some traders will buy with a limit order at that low. Many of them are willing to scale in lower. We broke below this low and we pulled back, but the sell signal bar is a doji bar and the breakout is weak, a small bear bar followed by a doji bar. Therefore, this is a bad looking low 1 bear flag, probably more buyers below. Traders will buy with a limit order at its low and get filled here. They'll also buy with a limit order at a new low at this low and get filled here. Bears will be doing the same thing at the top. We have a buy climax, breaking above a prior high, breaking above a bull channel, and we have a weak looking buy signal bar. We have a bull doji bar. Traders will sell above the high. Both bars have big tails, betting that there will be more sellers than buyers up there. Here, in the middle of the range, traders will sell with limit orders above highs, especially when the rally is weak. It looks more like a bull leg in a trading range than the start of a bull trend. Here, the bulls have a great looking bull bar, but it's a big bar, and therefore traders buying above its high and putting a stop below its low have big risk, and they're buying after 2 big bear bars at the top of a potential trading range, and therefore the probability is bad. When that happens, you can get a bull bar, but there probably are going to be more sellers at its high than buyers. Experienced traders will sell with the limit order at that high, betting that the bulls who buy there will lose money. When a trading range is tight, most traders should not trade, especially when it's very tight like this. But experienced traders will trade with limit orders, and they will scalp. Trading ranges often have legs that last 10, 20, 30 bars, and that often is long enough for traders to make a swing trade. A very strong bear reversal, 3 consecutive bear bars closing near their lows, and we have a low 1 short, and now another short. It's a reasonable swing trade, hoping that the market becomes a bear trend. It ended up trading down for another 20 bars or so, but the sell-off was weak. It lacked consecutive big bear bars and had many reversals. It was therefore more likely a bear leg in a trading range. Here, this is a very tight range within a broader range. And when the range is tight like this, I'll talk about tight ranges later on, but when a range is very tight like this, it's very difficult to make money. You're looking for a minimum scalp, maybe 1 or 2 points, and it's very difficult to make money when the range is only a little bit bigger than the size of a minimum scalp. Experienced traders will enter with limit orders. Here's a bull bar after 3 bear bars. They'll buy below the bull bar, betting that it's a bad sell. Here's a bear inside bar near the top of a developing tight trading range. Traders will sell at the high of that bar, betting that it's a bad buy. This is a bull channel, this is a bear channel, and this is a trading range. When the market's in a bull channel, traders try to buy pullbacks into the bottom half of the range, whether it's a bull channel or a bear channel as well. If it's a broad enough bear channel, traders will look to buy in the bottom half of the range, like below prior lows. And in a bear channel, traders will look to sell in the top half of the range. If the market's in a bull channel and it has pretty deep pullbacks, in other words, a pretty broad channel, traders will look to sell in the top half of the range. In a trading range, rather than simply buying in the bottom half, it's usually better to buy in the bottom third because the market typically retraces very close to the low. The opposite is true at the high. It's usually better to sell in the upper third of the range rather than in the middle third. The middle third of the range, the market tends to spend most of its time in the middle third of the range, briefly breaking in the lower third, briefly breaking in the upper third, but this is the best place to sell, and this is the best place to buy. And in the middle third, traders usually should do very little trading if they trade at all. Markets are either in trends or in trading ranges, and they transition one from the other. A trading range eventually has a successful breakout, and a trend eventually evolves into a trading range. It's helpful to look at a trend for early signs of conversion into a trading range, because once it's a trading range, you're going to be trading it differently from how you trade it when it was a trend. Strong rally here, strong rally here. I always want to know what the bars to the left look like, and that tells me how I'm going to be trading this breakout. The probability of higher prices depends a lot upon the bars to the left. Here, we have a breakout, 3 consecutive bull bars closing in their highs, another 4 consecutive bull bars, 2 of them good-sized bodies, breaking above a range. This is a strong breakout. Probably it'll either be a bull trend, a pullback and follow through up, or a bull leg in a bigger trading range. In either case, buying up here is a good bet because even if it is a bull leg in a trading range, it'll trade back down here. It'll come back up here because trading ranges trade down and they trade up. So this is a good buy, expecting higher prices or at least a pullback that will come back to this price and you can avoid a loss. When the breakout is far above the bars to the left, it's more likely to be the start of a bull trend, and therefore you can expect higher prices. On the other hand, look at this breakout. It looked even stronger than this one, but look to the left. It's not nearly as strong as the sell-off that preceded it, and it did not go above this high. Do you think this is a bull leg in a trading range, or do you think this is the start of a big bull trend? Is it above all the bars to the left? This was above all the bars to the left, and likely to have follow-through buying. This, we had a big move up, a big move down, and therefore big confusion, and big confusion usually means a trading range. And now we have another big move up, so big move down, big move up, probably trading range. Therefore, this is probably a bull leg in a trading range. A lot of times, trading ranges are filled with 2- and 3-legged moves, and sometimes the 2-legged moves are not so obvious. However, we went up here, a bull bar, and then a bear bar. It's possible that this is the second leg up in a trading range. First leg here, pull back, second leg here. When you have a strong breakout like this, especially if it's a second leg up, but it's not above all the bars to the recent left, the most recent 10, 20, 30, 40 bars, it's probably going to be a bull leg and what will become a trading range, and less likely to be the beginning of a bull trend. If this continues up here well above this bar, and it has a couple strong bull bars like this closing above prior bars, then we can start talking about it as being the start of a bull trend. But as long as it's not breaking above a prior major lower high, it's still more likely to be a bull leg in a trading range. Persistent breakout, it's a spike. On a higher time frame chart, it would simply be 2 or 3 bull bars. And then a pullback, you can call it a triangle, you can call it a wedge, bull flag, 3 legs down, 1, and then bull bars, and then 2, pullback, and then 3, spike, pullback, and channel, strong bull trend. And this reversed down deeply, strong enough up so that it's probably a bull leg in a trading range and not a pullback in a bear trend. Therefore, even if a trader bought here, if they bought more lower, chances are they could get out with a profit on their lower entry and get out break even on their first entry. The point is, when the breakout is above the bars to the left, higher chance of being a trend. When it's a strong breakout but not above the bars to the left, higher probability it'll be a bull leg in what will become a trading range and not the start of a bull trend. I mentioned a moment ago confusion as being one of the hallmarks of a trading range. Strong bear breakout. We have 5 consecutive bear bars, 3 of them good-sized bodies, all 5 closing below their midpoints. And therefore, you have to be thinking that it could be the possible start of a bear trend, or it could simply be a bear leg that could end up as a trading range. It's unlikely to immediately reverse up into a bull trend. When it's strongly down like this, the odds are it's either the start of a bear trend or the start of a trading range, and either case, bears will sell the first rally. If it's a trend, the pullback will be small. If the pullback is deep and retraces most of this, then we're probably forming a trading range. Beginners will look at this and they'll only consider one possibility, bear trend. But that's not the only possibility. Realistically, a strong sell-off like this is either the start of a bear trend or a bear leg in what will become a trading range. Traders know that nothing is 100%, and even when they see a strong sell-off like this, there's probably only a 60% chance it's going to lead to a measured move down in a trend. And there's a 40% chance that it will not, that it will reverse up and most likely become a trading range. It could reverse up into a bull trend, but when it's this strongly down, usually the first reversal up is minor, and you get a trading range instead of a bull trend. And now we have a reversal. We have 4 bull bars, all closing above their midpoints, 3 closing on their highs, undoing much of the bearishness that we have right here. Look to the left. It's still below this high, so this could very well be a bull leg in a trading range. Strong enough reversal up, probably if we reverse down, bulls will buy it and we'll test back up here again. Big down, big up creates big confusion. Big confusion usually results in a trading range. You have disappointed bears who are disappointed by seeing this, and you might get disappointed bulls. Disappointment is one of the hallmarks of a trading range. The other is confusion. And by disappointment, this is an example of disappointment. The bears think they're going to get a bear trend, and then they get a big reversal up. Some bulls think it's going to be a bull trend, but if it's a trading range, they'll soon be disappointed. When the market's in a trading range, you never know where the bottom or top is until after there's a pretty strong reversal. At this moment, this is a pretty good candidate for the bottom, and after this strong sell-off, this is a pretty good candidate for the top. But trading ranges constantly break above prior highs, even major highs like this, and they constantly break below lows, even a major low like this, and then reverse. Markets have inertia. Remember my inertia rule. 80% of the time when the market's trying to break out into a trend, it's going to fail and it will reverse, even if the leg down or the leg up is strong. If traders think it's a trading range, and after big down, big up, they are thinking trading range, they'll start to look to sell near the top and scale in higher, betting against a bull trend, and they'll look to buy near the bottom and scale in lower, betting against a bear trend. And they'll take quick profits because buying down here, they're not expecting a bull trend. They're expecting a bull leg in a trading range. And up here, they're going to take quick profits as well because they're not expecting a bear trend. They're expecting a sell-off that will be a bear leg in the trading range. The bears have a small second leg down here, a better second leg down here. They were expecting a second leg down after such a strong sell-off, but the bulls are expecting a second leg up after such a strong rally. Remember, trading ranges often have two-legged moves, one pullback two, one pullback two, and after such a strong rally, chances are we're going to test back up. This might be the test up, but this is strong enough so that we're probably going to come up to this high close area. Consecutive bear bars, maybe it's a bear trend again. It's not. You see this and you thought it was a bear trend, you were disappointed. You see this, you think it was a bull trend, and now you're disappointed. Now you're seeing bear bars again. Well, we have big down, big up, big confusion. We're probably in a trading range. And therefore, while this might be a measuring gap, this close is below that low, and we might get a measured move down based upon the height of this small trading range. More likely, the gap will close, and this will end up as a bear leg in what will become a trading range. Gap between this close and that low, and might lead to a measured move down from this high to that low. But more likely, it's a two-legged move down in a trading range. And skilled traders will look at that and say, we got a bear bar but a bull bar. We have a bear bar but a bull bar. The follow-through after the bear bars is bad. We have a big tail on the bottom of this bull bar. The bear bar here is shrinking compared to that bar. We're in an area where the bulls bought strongly twice, one pullback two. This is probably more likely a bear leg in a trading range. And the bulls will be looking to buy. They'll buy this close. They'll buy at that low, and they'll certainly buy the reversal up. And they'll be scalping because they're not expecting a bull trend. They're expecting that any rally will not go very far and that the market will continue sideways. Double bottom, higher low. You can call it a bear trend, bull breakout, double bottom, higher low, major trend reversal. But only 40% of major trend reversals actually lead to a major trend reversal into an opposite trend, a bull trend. More likely, this rally is a two-legged move up in a trading range. And a lot of times the legs are nested. Two legs up, one pullback two, two legs down, one pullback two. The first leg subdivided into two legs. The second leg subdivided into a wedge, one pullback two, pullback three. And this might be simply two legs up in a trading range. This could be a second leg trap. It's very common in a trading range to get a second leg that is especially strong, making traders believe it'll be a measuring gap in the start of a bull trend, and then it simply reverses. And you'll also get second leg traps near the bottom, trapping beginners into thinking that the trading range is going to break to the downside, and that strong second leg reverses back up. Five consecutive bull bars, four of them closing above their midpoints, two closing on their highs. Beginners see this as a breakout. Just like the bears thought that this bear bar was going to successfully break out below this low, beginning bulls think that this bar is going to remain a breakout above this high, and this close is going to remain above that high. But look to the left. We're still below the top of the bear leg, and this could be simply a big two-legged move up. One, pullback, and two, where the pullback subdivided and the rally subdivided. It's not clearly bullish yet. It's still more likely a bull leg in a trading range. And therefore bears will look to sell, and bulls will look to sell out of their longs to take profits. Two legs up, one pullback two, two legs down, one pullback two, two legs up, one pullback two. Probable second leg trap. I'll talk about that later, where you have a very strong second leg, trapping traders into thinking the market is turning into a trend, but it traps bulls into buying high. You get second leg traps at the bottom, trapping bears into selling low. And trading ranges disappoint traders. Chances are the bulls will be disappointed and we'll get a reversal, which we did. A very tight channel lasting 8 bars, 4 with pretty good bear bodies, and 7 bars without a bull body. Beginners see that as what they hope is the start of a bear trend. A big low 2 rally, 1 pullback 2. So the bears are hoping this is a big bear flag after this initial sell-off, and they're hoping to get trend resumption down. Experienced traders know that bear legs accelerate near the bottom, and the bear leg looks strongest near the bottom of the range, and the bull legs often look strongest near the top of the range. Yet, trading ranges have inertia. 80% of the breakout attempts will fail. We tried to get a bear breakout. It failed. A bull breakout, a bear breakout, a bear breakout, a bull breakout, a bear breakout. It's better to bet on reversals than bet on successful breakouts. And 2 small legs down, 1, and then a high 1, and then a high 2, a double bottom bull flag, and a rally, a small pullback bull trend for the rest of the day. But it's still in the trading range, and therefore bull leg in a trading range, bear leg in a trading range, not the start of a bear trend, and bull leg in a trading range. In trading ranges, as I said, traders are constantly disappointed, and sometimes you'll get good-looking setups and they just don't seem to work. And that means that the probability is never quite as high as you want, and bad setups seem to work pretty well when you think, gosh, they shouldn't work at all. They're low probability bets, but they work much more often than you think. So there are very few really high probability setups and very few really low probability setups. The probabilities tend to hover closer to 50% instead of 40% and 60%. It generates confusion. Five consecutive bear bars and a doji bar, you think, well, that's a bad looking buy. Well, it's a trading range. You don't know that at this moment, but if ever you see bad looking buy signals lead to profitable trades or bad looking sell signals lead to profitable trades, then you're having low probability trades working pretty well. You have to assume that the market's probably in a trading range. The same right there, 4 consecutive bull bars, yet we had a swing down lasting more than 20 bars. We have a double bottom or a slightly higher low, major trend reversal, bear trend, bull breakout, higher low, a high 2 buy, good looking bull bar. You think it's a high probability trade, but the market went sideways for about 30 bars. A bull body after 3 bull bars and the market's trying to turn up, you wouldn't think it would lead to much of a sell-off, but we had 2 big bear bars and 2 legs down, 1 pullback 2. Low probability sell, but it's still got 2 legs down. Low probability events are not as low probability as you think when the market's in a trading range. And if you see low probability events being profitable up and down, that's a sign that the market is probably in a trading range. You're not going to trade a chart that looks like this. This is 200 or 300 bars. You're only going to be trading a screen that has 100 bars or so. However, I'm putting all these bars here to illustrate a point about support and resistance. Prior highs are resistance, and if the market breaks above a prior high, then that prior high becomes support. We broke out above these highs and it became support. The market reversed up. When the market reverses down here, at the time, you don't know that that is resistance. But after it has reversed down, you assume that it's resistance, and if the market gets up there again, it'll sell off again. So prior highs are always resistance. We tried to rally here, we sold off. You expect that when we get back there, maybe the bears will win again, and the bears will win again. And you expect the bears to win again, but here they didn't win so well, and we went to a new high. However, the bears won above this high. Resistance is a force above the current price where there might be more sellers than buyers. And support is the opposite. Support is a level below the current price where there probably are going to be more buyers than sellers. Support keeps the market from falling too far, and it tends to keep the market in a trading range. A prior low, the market reversed up. Broke below this low, reversed up. The market reversed up repeatedly here. When it got down there again, it reversed up. When it got near it again, it reversed up. When the market's in a trading range, the bulls and bears alternate control. The bulls make money during the bull legs, and the bears make money during the bear legs. A range is simply a market that's mostly sideways with repeated reversals. Usually, a trading range has at least one bull leg lasting 10 or 20 bars or more, and one bear leg lasting 10 or 20 bars. The market's usually always in long and also always in short. you get some kind of big up, big down, big confusion appearance to the chart, and you have to assume the market is probably sideways. Especially when you look at these bars, it keeps reversing every 2 or 3 bars. It lacks consecutive big bars. We have consecutive big bars here, but disappointing and terrible follow through. When you look at a chart and you see a swing up where the market's clearly always in long, you see a swing down where it's clearly always in short, you have to assume the market's in a trading range. Usually before you can conclude that the market's in a trading range, you need to see 2 legs up and 2 legs down. 1 pullback 2, 1 101 pullback 2. So at this point, the market is probably in a trading range. It's still possibly a bull trend. It might be forming a double bottom and it may rally forever. Here it rallied for 100 bars. So it was in a bull trend and it was also in a bear trend. It could have sold off forever and this could have been the start of a bear trend. Whenever the market's in a trading range, it's also always in a bull trend and always in a bear trend. However, only one side ultimately wins. Here the bulls won for about 100 bars. Once you see 2 legs up and 2 legs down, it could be in either order. It could be 2 legs down and then 2 legs up. You have to assume that the market is more likely in a trading range than in a bull or bear channel. 2 legs up, 2 legs down. You have to conclude that we're now in a trading range and we're probably going to go sideways for an indefinite number of bars, 10 or 20 bars, maybe more. Ultimately, the market went sideways for, 250 bars or so, the entire screen. I mentioned before that when the market's in a trading range, the legs up and down often have subdivisions into 2 legs or 3 legs. You can see this first leg up, 1 pullback 2, subdivided into 1 pullback 2, or into a wedge, 1, 2, 3. 2 legs down, 1 pullback 2. 2 big legs up, 1 pullback 2. This had a subdivision into 2 legs. This subdivided into 3. So this breakout led to a wedge. Or you can do it the other way. This could be a wedge, 1, 2, 3, and then this breakout led to 2 legs up. 2 legs up, 1 pullback 2, and it's subdivided into multiple other smaller patterns. 2 legs down, 1 pullback, maybe 2. Well, 2 continued down, and now it became 1 pullback wedge. So spike and channel bear trend. You sometimes hear me use the term fractal. Markets are fractal. And by that, what I mean is that any pattern that you see often subdivides into smaller, similar patterns. A trading range subdivides into lots of smaller trading ranges. This is a trading range, this is a trading range, and this is a trading range. And within them, there are smaller trading ranges as well. Inside trading ranges, you frequently see doji bars, bars that close near their middle and have prominent tails. A single doji bar is a 1-bar trading range. And if you were to look at a smaller time frame chart, you would see that it's a trading range. For example, this bull doji, the market went down and it went up, like this, down and up. Big down, big up usually results in a trading range. And therefore, when you see a lot of dojis on the chart, you're probably going to be mostly in a sideways market. Traders are always looking for signs of whether or not the market is in a trend or in a trading range. When I think the market might be in a trading range, I'm looking for evidence that it probably is. Very often, as soon as the day begins or the session begins, you can tell from the first bar that a trading range is likely. If you start seeing early signs of a trading range, traders will begin to trade it like a trading range rather than like a trend. Here's the start of a day, big up, big down, big confusion, big up again, probably going to be a trading range. Here we have a breakout of a channel with lots of reversals. Instead of consecutive bear bars, we have a bear bar and a bull bar and prominent tails. A couple bear bars, a good bull bar. Increases the chances that today is going to have a lot of trading range price action. Everybody knows that a trading range will eventually evolve into a trend, that there'll be a breakout. However, they also know that while it's in a trading range and until it clearly has broken out into a trend, traders can make much more money trading it like a trading range, betting against successful breakouts, knowing that eventually they'll probably lose. Eventually, one of their times when they sell at the top or buy at the bottom, there'll be a successful breakout into a trend. So if they buy at the bottom, it'll end up breaking into a bear trend eventually. Or if they sell at the top, eventually it'll break out into a bull trend. But they'll make enough money on all the prior trades to offset the final loss, if they even get the final loss. A lot of traders won't take that last trade because there'll be signs that the market might be evolving into a trend. I'm always looking at the bars. What is the evidence that the market might be in a trend? Well, we have consecutive bear bars, but they're not particularly big. And if you look to the left, we see multiple reversals. The bodies seem a little bit too small to change the price action that we're seeing. Also, the tails are a little bit prominent. Tail on top of this bar, tail below that bar. And here we're getting a bull reversal, but prominent tails and the bodies are not all that big. Therefore, this is more likely a bull leg in a trading range than the start of a strong bull trend. More bars with prominent tails. We're trying to get a bull breakout, but several of these bars have tails on top. Here we're getting a bull breakout and follow through, tail on top, and we're not clearly far above the bars to the left. And the same here. We're selling off, but we're getting tails on the bottom of the bars, and therefore the sell-off is probably not all that strong. A lot of the bars have small bodies. If they're small enough, you can call them a doji, or you can simply call them small trend bars. Instead of consecutive big bars closing on their highs and the legs up, or consecutive big bars closing on their lows on the way down, we get a lot of bars with small bodies and prominent tails. Evidence that the market's more likely in a trading range. Lots of tight trading ranges, lots of overlap, many reversals in a very small range. That is further evidence of a tight trading range. I talked about how trading ranges can be broad or tight, and when they're broad, traders can buy low, sell high, and scalp, and they can enter with stops or limit orders. When they're tight, most traders should not trade, but experienced traders will trade them with limit orders. I'm also always looking for early signs that the market might be in a trading range. Are there a lot of bars with prominent tails, small bodies? Is there an absence of consecutive strong trend bars up or down? Are there a lot of reversals? Are there a lot of two-legged moves up and down? All of that is evidence that the market is probably in a trading range. And if it is, I'm going to start trading it as if it's in a trading range. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading within trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading in trading ranges. I want to begin by talking about my 80% rule, and that is that the market has inertia. 80% of the time when it's in a trend and it tries to reverse, the reversal will fail. And 80% of the time when the market's in a trading range and it tries to break out, the breakout will fail and reverse. There are characteristics that distinguish legs within a trend from legs within a trading range, and I want to talk about some of those characteristics. When the market's in a trading range, traders want to buy in the bottom half and sell in the top half. The market is in a trading range. There's a smaller range. The whole thing is a trading range by the end here. I talked about how markets have inertia, and that means they are resistant to change and they tend to continue what they've been doing. In a trading range, 80% of the time, the market will have breakout attempts that are strong, up and down, and they'll fail and lead to reversals instead of a successful breakout into a trend. We have a strong reversal down, but it stops after a bar or two. Pretty strong reversal up, it stops after 2 or 3 bars. 3 consecutive bear bars, the market reverses up. That lack of consecutive strong trend bars here, a lack of consecutive strong bull bars. Here, a lack of consecutive strong bear bars. Here, we have a couple bear bars but a tail. And then we have a doji bar and then a bear bar and then a bull bar. We have a couple bear bars and then a bull bar. That lack of consecutive strong bear bars is much more common when the market is in a bear leg in a trading range or in a bull leg in a trading range. The bulls have a good bar here, but a doji here, a bull bar here, a doji here, a good bull bar here, but then a follow-through bar with a tail on top, and then we have a micro double top here at a prior high. Whenever there is a good trend bar, the follow-through tends to be bad. Big bull bar and then a doji bar, big bull bar, a doji bar, big bull bar, a bear doji, a pair of bear bars, and then a tail below and a doji bar here. The market breaks below a major low, like here, but it reverses up. Here it breaks above a prior high. Good breakout, it reverses down. Breaks out above a high, reverses down. So bad follow through on breakouts. That's another characteristic of trading ranges. So if you see legs up and down and they break out above highs and lows but reverse, that is a sign that the market is probably in a leg and a trading range and not in a trend. When the market's rallying, I pay a lot of attention to whether or not the bears can make money. And if the bears can make money selling at a prior high or selling at a prior high and scaling in, then the market is probably in a bull leg in what will become a trading range and not a bull leg that is becoming a bull trend. Here, if the bears sold above this high one bull flag, we have a rally, a pullback. If the bears can make money selling breakouts of bull flags, high one and high two bull flags, that's a problem. That's a sign that the bulls are not all that strong. The bears who sold at the high of this bear bar, a high one bull flag, made money. And that should not happen, or should not happen often, if this is the start of a bull trend. The bulls have a double bottom and they're trying to reverse up. Is this going to be the start of a bull trend, or is this going to be a bull leg in a trading range? The rally can last 2 or 3 hours, 30, 40, 50 bars. However, it's still more likely going to be a leg in what will become a trading range and not the start of a bull trend. Can bears sell at a prior high and make money? And here they could. They sell at that high, and the market fell far enough for them to make a profit. Can they sell a reversal down from a prior high and make money? And yes, they could. These bears made money. They got out here, and the same thing here. Bears selling at this high, bears selling on the reversal down. The market fell far enough for the bears to make money. Bears selling at this high, using a wide stop and scaling in. They made money as well. They sell more higher. They can sell more either at a fixed number of points above, they can sell more above a bad bull flag above this bear bar, or they can sell on a reversal down. Many different ways to scale in higher. Then they get out at their first entry price, break even on their first entry, and then with a profit on their higher entry. Same thing here, sell at that high, scale in higher. And the market fell back to their original entry price, and they can make money. Obviously, if they sell and the market immediately goes down, there's no need to scale in higher. But sometimes they sell and the market goes up higher. But because the bears have been making money selling above bars repeatedly through here, the bears are confident that they'll make money selling at this high as well if they use a wide stop and scale in higher. And because the market fell back below the breakout point, as it did for all of these breakouts, it kept pulling back below the breakout point. That is a stairs type pattern, and that's more common in a bull trend that will soon evolve into a trading range. The opposite is true of a bear trend. If the bulls can make money repeatedly buying below bars, scaling in, buying reversals up, then the leg down is probably a leg in a trading range and not the start of a bear trend. For example, if bulls place a limit order to buy at this low, betting against a successful breakout, and they can make money buying there, then that makes it less likely that this is going to lead to a big bear trend. Here they bought that low, it rallied a point, they could exit with a 1-point profit. And same thing there, they buy at the new low. Here they had to scale in lower and went back to their original entry price. They could get out with a 1-point profit on their second entry and get out break even on their first entry. They bought here and then they get out there, break even. Let's say a bull bought below this bar. For the bears, it's a bear channel, a bear trend, and it's a low one bear flag, but it's a bull body and it's after a bull bar here. It's probably not a very good low one bear flag, and therefore some bulls would buy with the limit order at the low of that bull bar, and then they'll scalp out. Again, bulls making money in a bear trend. The bear trend is probably a bear leg and what will end up as a trading range. Also, buying a reversal up. We broke below this low, we broke below that low, and we're getting a reversal and a second reversal up, and the bulls made money buying above that reversal bar. In trading ranges, a lot of the probabilities gravitate toward 50%. Setups that would normally be high probability in a trend, like a 60% setup, are closer to 50% in a trading range. And setups that are typically low probability in a trend, like a 40% setup, are also closer to 50%. When lower probability outcomes happen more than what you'd expect, then you have to assume the market's probably in a trading range. The first reversal down after a strong breakout to a new high, probably buyers below the low of the bar. I'm not going to be buying at the low of a strong bear bar after a breakout because too often it's a trap. However, the odds are there are buyers below, and bulls buying at that low can scale in lower. When you see a strong breakout like this, you know several things. You know the market's probably not in a bear trend, but it's either in a bull trend and it will go up without much of a pullback, or it's a bull leg in what will become a trading range. In which case, if you're buying up here, you need to stop down here or down here, because if it's a bull leg in a trading range, you can get a very deep pullback. You can get a bear leg in a trading range, and it could even go below the bottom of the range. Strong rally, 60% chance there'll be a second leg up, and bulls will buy the reversal down. However, it's a possible second leg trap. One leg up, a wedge rally, and then a pullback, and then a second leg up that's especially strong. It's still a 60% chance that it's going to have a second leg up, but if it does have a deep pullback, in other words, if the 40% happens, then you have to be thinking that maybe this is a rally that is part of a trading range and not the start of a big bull trend. Strong reversal down, a pair of bear bars, and then a deep pullback. Therefore, this rally is more likely a bull leg in what will become a trading range instead of the start of a bull trend. Whenever something is a high probability setup in a trend, and you see that pattern setting up in what you think is a trading range, the probability is not as high as you think. It's probably more like 50% instead of 60%. Head and shoulders top, left shoulder, head, and then right shoulder. And there's also a double top bear flag. You would think 60% chance we would test the low, the neckline of the head and shoulders top. But because so much of the trading is sideways, trading range, the probabilities are rarely ever 60%. So it's closer to 50-50. We got a pretty strong reversal up after the sell-off, a sign that instead of a continued bear trend, lower highs and lower lows, this is probably a bear leg in a trading range. And then this is probably the start of a bull leg in that same trading range. I said that when the market's in a trading range and you have a rally or a sell-off, you get pullbacks beyond breakout points. In other words, a stairs type of pattern. That means most gaps close. Here we have a gap between the close of this bar and the high of the prior bar. But if it's a bull trend, higher probability the gap will stay open. The next bar, the low fell below the high of the breakout point and the gap closed. That is more common if the rally is going to be a bull leg in a trading range. You can see the pullback. The following bar had a low below the high of the breakout point. Strong breakout above a prior high, and the market immediately pulled back below the high, and the pullback here went far below the breakout point. That gap closed. These pullbacks allow bears to get out without a loss. So bears selling at this high, they could be disappointed by the size of this bull bar and decide they want to get out break even. The next bar fell below the breakout point and allowed the bears to get out break even. And the same right here. The bears who sold at this high, the pullback was deep enough for them to make a profit. If the bears can sell and avoid a loss like this or make a profit like this, then the rally probably is going to be a bull leg in what will end up as a trading range. And the opposite is true for the bears. We have a gap between this close and that low. Then we had a reversal back up above the breakout point, and therefore the bulls who bought that low right here, if they did not scale in, this rally back above their entry price allowed them to get out without a loss. If they did scale in, the rally allowed them to make a profit. We have a gap here, right here, this close and that low, and a bigger breakout here, this close and that low. And look at the pullback. The pullback went above the top of the bear swing. So bear gaps are also closing, just like the bull gaps are closing, and that's one of the characteristics of a trading range. I want to talk a little bit about legs within a trading range instead of in a trend. Pretty good rally, a very tight channel, a bull breakout, but look to the left. We're barely above the top of the trend. We're in a broad bull channel at this point. We have higher highs and higher lows, but it's either a bull leg in a broad bull channel or a bull leg in a trading range. Look at the lack of consecutive big bull bars closing on their highs. The bull bars that do close on their highs are not big, and we do not have consecutive big bull bars. That is a characteristic of a rally that will end up in a trading range. In other words, it'll lead to a bear leg and not to a bull trend. We get all of these tails on the tops of the bars and the pullbacks because the bulls are taking partial profits. When the market goes up a little, they take profits. They lack confidence that the trend will continue up very far, so they keep taking profits. The bears do not want to sell too low. They see the market's probably in a trading range, maybe a broad bull channel. They want to sell high. They want to sell above prior highs. And very often they don't want to sell too low below the prior high. That lack of selling by the bears can lead to a pretty strong reversal up. They want to sell high. They don't want to sell low. So why is the market rallying? It's rallying because there are not many sellers down here. So there are a lack of sellers. The market has to go higher to find a price where bears are willing to sell. This is, I think, important to distinguish from what I was just showing. We have a lack of consecutive big bull bars. We have decent bull bar, but not consecutive big bull bars. Terrible follow through. The same here, terrible follow through, terrible follow through. But what's different between this rally and all the rallies that I've shown so far today? This, gaps. Whenever a rally looks weak and it looks like a bull leg in a trading range, but it's forming gaps and negative gaps, slight overlap. We have a breakout and a pullback, could not fall below this breakout point. We have a breakout, does not look all that strong, but look at the pullback here, 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 could not fall below the breakout point. If you have a rally that looks weak, but it's forming 2 or 3 gaps, it's probably a small pullback bull trend, and it probably is a bull trend and not a bull leg in a trading range. These gaps often lead to measured moves up. If the market's forming gaps or negative gaps, just a little bit of an overlap, do not sell at prior highs and scale in higher because you will lose money. For example, if you sold this high and scaled in higher, it never came back below the breakout point. and you would have had to buy back your short with a loss. You would lose money. It's a small pullback bull trend, not a bull leg in a trading range. Here, gap, and it did lead to a measured move up. And you can see some profit taking at the measured move up. Aggressive bears might sell there for a scalp. Most of the selling is due to bulls taking profits. We have a sell-off. We have a couple bear bars. Why does this look weak? Why does it look like a bear leg in a trading range? Well, the bears are lacking conviction. We keep getting pauses after big bear bars because every time the bears see a big bear bar, they see it as a gift, a surprisingly big bar, allowing them to buy back their shorts for a profit. They're taking quick profits. So we keep getting reversals after big bear bars instead of a series of consecutive big bear bars. The bears lack conviction. They do not believe the market is going down very far. They're not selling at lows. They're waiting to sell pullbacks. They're buying back their shorts every strong bear bar, betting that the market will pull back. The bulls see that as well, but they don't want to be buying high. They suspect it's a trading range and they prefer to buy low. These little reversals are more due to bears taking profits and then selling again than from bulls buying because they're not willing to buy too high up in a weak rally or at the top of a trading range. The bulls want to buy low and the market's falling because of a lack of buyers, not because of enthusiastic sellers. The bears keep buying back their shorts every time there's a strong bear bar. We have a bear bar, bad follow through. Bear bar is not all that big. Bad follow through, lots of reversals up, but a small pullback bear trend. We're getting gaps, and that increases the chances that this is a bear trend and not just a bear leg in what will become a trading range. It's a very strong type of bear trend, even though it looks weak. Traders should not be buying. A pullback not overlapping the breakout point, a pullback not overlapping a breakout point, small pullback bear trend. That is a bear trend. It turns out we got a reversal, and you can call the whole thing a trading range. But when you see a sell-off that does not look strong, yet it's forming gaps, it's probably a small pullback bear trend, and therefore it's probably going lower, a lot lower. Do not look to buy. We have a gap. We fell below a measured move from here to this potential measured move. We did fall to a measured move based upon this gap. It became a measuring gap. So when you're seeing a small pullback bear trend and you're getting gaps, you have to be thinking that one or more of those gaps will lead to a measured move down. I talked about the characteristics of a trading range leg versus a trend leg. All the signs that the market's in a trading range are due to how traders are trading. The traders believe the sell-offs will not get too far, and therefore they don't want to sell near the bottom. And the bulls believe the sell-offs and bear breakouts will fail, and they're looking to buy low, betting on a reversal up. And then the opposite is true when the market gets up near prior highs. The bears are much more interested in selling rallies, but they're not willing to hold their shorts for very long because they're not confident the reversals down will get very far. And the bulls are not willing to buy high. They're looking to sell rallies to take profits on the longs that they bought lower. Bulls are buying low, selling high. Bears are selling high and buying low. So both bulls and bears are buying low, selling high, and both are taking quick profits. And the result is a trading range. And that is why when the market's in a trading range, traders should look to buy low, sell high, and scalp, take quick profits. The bulls actually are buying bear reversals, betting that the reversals will fail. So a strong bear bar, a lot of bulls will buy that if they think this is a trading range, and they'll also buy a reversal up. And when the market's near the top, bears will do the opposite. Every time they see a strong bull bar, they'll sell it, and they'll sell a reversal down. A bull breakout, bears will sell. and they'll take profits, take quick profits on the way down. Neither the bulls nor the bears believe that the market's going to go very far up or down, and the result is they take quick profits. Sometimes they can swing trade, but in general, they're not expecting a big trend up or down, and they're looking to take quick profits. When the market's in a trading range, traders should look to buy low, buy in the bottom half, and sell high, sell in the top half. At this point, the market's in a trading range right here, and this is the top half. Bears are going to sell in the top half, and bulls are going to sell out of their longs to take profits. And in the bottom half, the opposite is true. The bears are going to buy back their shorts, and the bulls are going to buy to get long. As more bars get added, the trading range can expand, and you get a new top half and a new bottom half, and traders will do the same as they did earlier. And same here. At this point, the trading range high is up here, the low is down here, and bears will look to sell in the top half, and bulls will look to buy in the bottom half. Because both bulls and bears are buying low, selling high, and taking quick profits, the market continues sideways. The market will create a trading range when traders trade that way. As a trader, if you see evidence of a trading range, you should do exactly what the institutions are doing, and that's buy low, sell high, and scalp. Here's my acronym, BLSHS. Trading ranges often have very deep pullbacks, and therefore a lot of traders prefer to buy in the bottom third and sell in the top third and do nothing in the middle third. At this point, we have a trading range. It looks like a bull leg in a trading range. Traders want to sell in the top third and buy in the bottom third, either with limit orders or reversals up. At this point, the trading range is bigger. Traders want to sell in the top third, buy in the bottom third. A bigger trading range. Whenever the market's in the bottom third, they're looking to buy, either with a limit order on a reversal up, and when it's in the top third, they're looking for reasons to sell, like a reversal down, especially a reversal down above a prior high. In general, stops can be very far away because a lot of traders will use wide stops and scale in, and the result is the risk is big, so the risk-reward ratio is not all that good. You're taking quick profits, so the reward is not all that big. Because most breakouts fail, the probability is low when buying near the top and selling near the bottom. If you're buying up here betting on a breakout, you're probably going to lose. The probability is the breakout will fail. And the opposite's true, selling in the lower third, betting on a breakout and the conversion into a bear trend, a low probability bet. Therefore, if you're looking to buy at the top, your stop is far away, the risk is big, probably not much reward, and the probability is low. That's a bad trader's equation for traders looking to buy high, and the opposite is true for traders looking to sell low. If you're selling down here, your stop is up here, your risk is big, your reward is probably not great because we're in a trading range, it's probably not going to fall all that far. So you have bad risk reward, and you have low probability because most breakout attempts fail, and this attempt to convert into a bear trend probably will fail. So it's better to look to buy low and sell high. A stop entry is a bet on a breakout and a trend. When the market's in a tight trading range, instead of buying with stops at the top, betting on a trend, it's better to sell with a limit order at the top, betting on a continued tight trading range. Instead of selling with a stop at the bottom, betting on the conversion into a trend, it's better to be buying with a limit order, betting on a failed breakout and a reversal back up into the tight trading range. When the range is very tight, most traders should not trade. It's a limit order market, easier to make money selling above bars and buying below, betting that breakouts will fail. A limit order is basically the opposite of a stop order. A stop order is betting that a trend is beginning. A limit order is betting that there'll be a reversal instead of a trend. Better to be looking to buy below and sell above and not the opposite. Very often you'll get very big signal bars inside of trading ranges. They look strong, but if you look to the left, you see the market's in a trading range, so the context is bad. So for example, here we have a very big bear bar. Do you really want to be selling below that big bear bar? No, it's a big bar, so the risk is big. At a minimum, the stop is above the bar, maybe all the way up here, and it's forcing you to sell at the bottom of a trading range. So the reward is small and the probability is bad. Probably more buyers than sellers below that big bear bar. And the opposite is true here with this big bull bar. The bar is big, so the stop is far, the risk is great. There's not much reward because it'll probably remain in a trading range, and the probability is not good buying in the top half, and therefore more likely sellers above, and better to make money selling with limit orders above. I began by talking about my 80% rule, and that is that 80% of breakout attempts in a trading range fail. Traders should look for reversals instead of breakouts. Next, I talked about characteristics of legs within a trading range in contrast to those within a trend. And finally, when the market's in a trading range, traders should look to buy in the bottom half and sell in the top half and take quick profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading in trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in trading ranges. When the market's in a trading range, it often has two-legged moves up and down. Sometimes the second leg is especially strong and it looks like the trading range is breaking out into a trend. However, 80% of trading range breakout attempts fail, and those strong second legs trap traders into buying high or selling low. They are second leg traps. Traders should be expecting breakouts to fail. They should be fading breakouts, betting that the breakouts will fail, looking for reversals. I'm going to talk about the ways to enter when the market's reversing down near the top of the range and reversing up near the bottom of the range. Traders often have to use fairly wide stops, and if they're able to scale in, that increases the probability that they'll be able to make money. This is a 5-minute chart. It has probably 300 bars on it, 250, 300 bars. When you're trading, you're not going to be looking at this many bars, but I have it up like this to illustrate that the market's been in a trading range for a long time. I want to be able to demonstrate several things about the trading range, and having this many bars on the screen allows me to do that. Trading ranges often have two-legged moves up and down, sometimes three-legged moves, wedges, and often the patterns are nested within bigger patterns. For example, we have a wedge rally here, 2 legs down here, 1 pullback 2, and then a rally here, which is just a second leg up. So leg 1, pullback, leg 2. And you can see leg 1 subdivided into either 2 or 3 legs. And lots of two-legged moves, 1 pullback 2, 1 pullback 2, 1 pullback 2, 1 pullback 2, 1, this whole thing being 1 pullback 2, 1 pullback 2, and 2 subdivided into 1 pullback 2. That's just normal trading range behavior. As I said, often legs subdivide into 3 pieces instead of 2. Lots of little wedges, lots of ways to draw the wedges. 1, 2, 3, wedge, bull flag. When a breakout below a double bottom reverses up, you have 3 legs down, 1, 2, and then 3. That's a variation of a wedge, and you can just see wedges all over the place, 3-legged moves, many ways to draw them. Very common to have legs within trading ranges that are wedges. Traders should look to buy reversals up from wedge bottoms or from 2 legs down. Couple legs down, 1 pullback 2 near the bottom of a range, buy the reversal up. Leg 1, ABC pullback, and then 2. So 2 legs down, also a double bottom, buy a reversal up. Small wedge bear flag pullback, buy the reversal up. A wedge bull flag, buy the reversal up. Reversed up, reversed up, reversed up. So 3 legs down, 3 legs up. And then a second entry buy here, very tight channel wedge. We have a micro wedge here, reversed up with that tail, and then a third leg here. Traders should also look to sell reversals down from 2 legs up or from wedge tops. 3 legs up, wedge rally, 3 legs, 1, 2, 3. It's also 2 legs, 1, 2. A big 3-legged pattern here, 1, 2, 3. And it's also a big 2-legged pattern here, 1, 2. And then 2 legs up, 1, pull back, 2. And then here we got a double top or a double top here and a break above the double top. You can call it a trading range with a double top and then a small wedge here. A second leg trap that is a strong second leg that looks like it's going to successfully break out into a trend, but it reverses instead of leading to a measured move. Beginners see a strong leg like this and they assume it's going to be the start of a trend, but then it simply reverses. It traps traders into buying high. And the same here, we have a first leg up and then a very strong second leg up. Bulls are hoping this is the start of a bull trend, but look to the left. We're still possibly in a trading range or a broad bull channel. Second leg traps are also common in broad channels up and down. And then here's a small second leg trap. 1, pull back, 2, trying to break out. Bulls are hoping for a trend up. They're looking at this as a bull trend and a pullback to a double bottom, and it traps traders into buying high. Beginners see 3, 4 consecutive bull bars. They start buying closes, betting that it's the start of a bull trend. They may even buy the highest close, hoping for a big bull breakout. And same up here. They'll be buying closes, hoping that the trading range is going to convert into a bull trend, and then they just get trapped into buying too high. Again, here, hoping for the breakout, beginners buy up here instead of down here. And same with up here. They're buying up here. They should be buying down here. Here, you don't know what the bars to the left look like. This might be part of a trading range. It's reasonable to buy closes. Here, here. Here I would not. We have a micro double top. On this bar, we went up and down, and now we're going up again, and this is a very big bar. So I personally would not buy that close. Too much risk of a double top and a pullback. The opposite is true on sell-offs. Beginners see big bear bars, hoping that it's the start of a bear trend, and they end up selling bear closes. But you look to the left, we're still in a trading range. Selling low, even when there are big bear bars, is usually a bad thing to do. More likely, the bear breakout will reverse than it is to break to the downside and fall for a measured move. The beginner sees 4 consecutive bear bars, big bear bar closing on his low, and he sells the close hoping this is the start of a bear trend. Instead, an expert looks at it and says, a big bear bar at the bottom of a trading range, that's a buy, not a sell. The beginner sells breakouts below bars, hoping that it's the start of a bear trend, not realizing that at the bottom of a trading range, 80% of breakouts will fail and reverse up. So he's doing the exact opposite of what he should be doing. The beginner bought too high and he sold too low. The beginner buying up here is shocked by how quickly the market reversed down, and same here. He's shocked by how quickly and relentlessly it reversed up. Same with up here. But that's how trading ranges behave. Incidentally, if you get a very strong breakout like that, especially when there's a possible micro double top, this tail and this bar, and then you get a bear bar closing on its low, it's usually good to get out below that bear bar, just in case this is a second leg trap. If you get a sell-off, you wait to buy. If you simply go sideways, you can buy again above a bull bar and bet on a successful breakout. A lot of beginners, they'll buy here, betting that it's either a bull leg leading to a bull trend or a bull leg in a trading range, and that will fall near the bottom and resume up. And the beginner is right. But invariably, if he buys up here, he sells out down here, and he may even reverse to short. And then he gets trapped in and he buys back his short way up here. He's doing the exact opposite of what he should be doing. When you can see the bars to the right, it's easy to say selling down here is dumb and buying up here is dumb. But real time, it's much harder to say that. And if you're a beginner and you're looking at the bars, you tend to be looking at the most recent bars and you're seeing bull trend and you're ignoring the bars to the left, which are telling you that it's either in a trading range or in a broad bull channel, and buying high in either case is a bad thing to do. Same with here. Traders only look at the most recent 2 or 3 bars and they buy too high. Here, especially, we're clearly in a trading range, and beginners only look at this big bear bar and they see some other bear bars here and they ignore all of this, that the market's at the bottom of a trading range and it's a losing strategy to sell there. For the bulls buying up here, there's a possible expanding triangle. 1, 2, and now 3. And we have consecutive big bear bars closing on their lows. If a trader did buy here or here, and if he did not get out below that bear bar, he really should get out on the close of this second bar. And at the bottom, expanding triangle tops usually lead to expanding triangle bottoms, and that's what we had here. So rather than selling here, hoping for a successful breakout, it makes more sense to look to buy a reversal up. Another expanding triangle. We went high, we went higher, and even higher still. Rather than buying up here, betting on a successful breakout, it makes more sense to wait to see if it reverses and then look to sell. Especially after you get 3 or 4 consecutive bear bars, traders, if they're long, will get out. If they're flat, aggressive traders will start selling at the market, selling at the close of the bear bars. Trading range, my 80% rule, 80% of breakout attempts will fail, and therefore it's better to bet that the breakouts will fail. And therefore, instead of buying at the top when the market's breaking out of the top, it makes more sense to sell a reversal back down, and the opposite is true at the bottom. When you see a strong breakout attempt at the bottom, look to buy a reversal up. Leg 1, pullback leg 2. Leg 1, pullback leg 2. Expert traders know that an exhaustion gap is more likely than a measuring gap when the market's in a trading range, and therefore they're looking to sell a reversal down. In fact, an aggressive trader might even sell this big close because it's an exceptionally big bar, and we have a tail on the top of this bar. The bulls will see this as an opportunity to sell. We're trying to break above the top of a triangle, and we have a micro double top potentially. And aggressive bears would sell that. Most bears would wait for a bear bar closing on its low and then sell below it, or wait for 2 or 3 bear bars and then start selling closes. Sell below a strong bear bar closing on its low. Sell the close of consecutive big bear bars, expecting at least a small second leg down. After 3 or 4 bars down, some traders will sell with limit orders at the high of the prior bar, betting on at least a small second leg down. This is really not an easy short. This rally is so strong, the odds are, even if we pull back, we'll form a higher low. When you see a strong rally like this, the odds are it's either the beginning of a bull trend or it's a bull leg in a trading range, in which case, if it sells off even to the bottom or below, it'll come back up again. However, I'm illustrating this as a second leg trap. As I said, you don't know what the bars to the left look like. We might be in a trading range already to the left. And if we were, I would never be buying up here. Same with up here. We're clearly in a trading range here and a broad bull channel. And whenever I see a very strong second leg up, I assume it's more likely an exhaustive move than the start of a bull trend. Some traders will sell with a limit order at this high, especially since it's a micro double top. We went up, down, up. Others prefer to enter with stops. Beginners should only be entering with stops, and they'll either sell the low, 1 tick below the low of this bear bar, or they'll wait for 3 or 4 bear bars, and then they'll start to sell closes. Big reversal down, reversing this bull bar, probably will have at least a little bit more down. So it's reasonable to sell the close of that bar as well. Whenever an expert sees 2 strong legs down in a trading range, he's looking to buy. He's expecting it to be an exhaustion move instead of a measuring gap and leading to lower prices. Reversal up is more likely. leg 1, pullback leg 2, big bear bar. If I'm trading this, I'm expecting this to be a bear trap, trapping beginners into selling at the bottom of a trading range. And I'm going to be looking to buy for a reversal up. You can buy with a limit order at that low, or you can buy a reversal up, especially above a bull bar, like above that bull bar, or a second entry buy. We went down, we went up, we went down, we went up. So buying above the high of that bear bar actually is a micro double bottom buy. And then a strong reversal up, big down, big up. Probably will get at least a little bit more up, so you can buy the close of that big bull bar. Very often when you look at a chart and you see a big bull bar and you're thinking, boy, the market needs just one more of these big bull bars and then everyone will conclude that the market's going higher. Whenever you see that, expert traders will sell the close, betting that you will not get that one more bull bar. Here we have a bull breakout and follow through, but it's more likely a trap, and therefore bears will sell strong bull closes after the market rallies several bars, betting that instead of the start of a bull trend, we'll get a pullback. The opposite is true with sell-offs. Whenever you see a strong bear bar and you say, boy, I really hope we get one more bear bar. As soon as you're hoping for that one more bear bar, it's usually better to buy. If you're an experienced trader, you'll simply buy the close. Big bear bar, bears need a little bit more to convince traders they've taken control. Well, bulls will buy that bear close. The same with here. All of these bear bars. You can see how the follow through is bad. Big bear bar followed by a bull bar. Bear bar, bull bar, bear bar, bad follow through. That tells you that whenever there's a big bear bar, the bulls are overwhelming the bears and creating reversals. And the opposite is true with the big bull bars. Look at the follow through after every breakout attempt. It's terrible. And that tells you that the bears are overwhelming the bulls at the top of each strong bull leg. I want to talk a little bit about how to enter on reversals. When you're in a trading range, a lot of times the first reversal from the bottom or the first reversal down from the top is not the final reversal. For example, we reversed up a second time here. We reversed up, sold off, reversed up a second time here. Most traders, if you see a strong leg down, it's usually better not to take the first reversal up. It's better to wait for a second reversal down. And the same is true at the top. Instead of taking the first reversal down, it's better to wait for a micro double top and then take a second reversal down. The probability is higher. Trying to reverse up, second reversal up here, higher probability leading to a leg up. When you're trading within a trading range, it's better to be using wide stops, like maybe below here, planning to scale in lower, but you don't want to take a second entry unless it's at least 2 or 3 times the size of a scalp below the first entry. So if you're trading the E-mini and the minimum scalp is 1 point, you do not want to take a second entry buy unless the second entry is 2 or 3 points below the first. Therefore, if you take this buy, I would not take that buy. But if you did not take this buy, this is a reasonable second entry buy. The same is true at the top. If you're selling a reasonable top here, you can call it a wedge 1, 2, 3, or 1, 2, 3, a failed breakout above a high. If the leg up is strong, here 5 consecutive bull bars, it's often better to wait for a second entry sell. Here's the first entry. That's not very good. This is a better second entry sell, a small double top lower high. Did not get very far. We have a new high here, and that would be a second entry reversal for the breakout above this high. When the market's in a trading range, traders are going to look to buy reversals up in the lower half and sell reversals down in the upper half. This is the sell zone, and this is the buy zone. And beginners should only be looking to enter with stops, buying with a stop on a reversal up from the bottom, selling with a stop on a reversal down from the top. A stop entry, the market's going your way, and that has a slightly higher probability of making a profit. We're in the top half of the developing range. Traders can sell with a stop below the low of that bar. Better if the bar has a bare body, which this does, and it's better if it's a second leg up, 1 pullback 2 and 1 pullback 2. At this point, the trading range is bigger. This pullback is into the lower half. Traders will look to buy a reversal up, especially a second entry. The first entry is above this little bull doji. This is a second entry and has a higher probability of being profitable. When a first leg down is strong, the probability is not all that good that buying the first reversal up will be profitable. It's higher probability to wait for a second entry buy. Here, a micro double bottom, it went up and then down on that bear bar, and now it's going up again. The high of that bear bar is the neckline of this small double bottom. Traders will buy on a stop above the high of that bear bar. Other traders will buy above this bull bar, closing on its high, a bull inside bar. They'll buy on a stop above its high and get filled right there. When you have a very strong rally, it's usually better to wait for a second entry sell, like a micro double top, or for a strong bear breakout. The market went up and down on this bar, and then it went up on that little bull bar, and then down again. The low of this bull bar is the neckline of this small double top. We went up and down, we went up, and we're going down again. So you can sell with a stop below the neckline of that micro double top, and you get filled right here as this bear bar falls below that bull doji. We have a micro double top here, up and then pause and then up again, but a very tight bull channel. Some traders will wait until there are 3 or 4 consecutive bear bars, especially if 2 or 3 of them close on their lows. And then when they see that, they'll simply hit sell the market when they see the close of that 3rd or 4th bear bar. Big reversal down and a follow-through bar. Most bulls are not going to buy the first reversal up. They might buy the second reversal up, but because most bulls won't buy the first reversal up, selling the close for a trade down is a reasonable thing to do. Trading ranges, you're never really certain if a reversal will work. The probabilities are not as high as you would like them to be. And because of that, experienced traders will use wide stops and scale in to increase their probability. If you buy here, reasonable to put a stop down here. We got a reversal up from a lower low, 2 legs down, 1 pullback 2. If you buy here, reasonable to put a stop here. Opposite's true up here. We have a micro double top, reasonable to take that sell and put a stop just above. Here we have 4 bear bars, 3 or 4 bear bars. If you sell there, reasonable to put a stop above the top of that bear leg. I'm going to talk in later slides about how experienced traders trade these things. A lot of times they'll trade small, use wide stops, and scale in. Beginners should never be scaling in, and they should never be using wide stops. If they get stopped out, they can enter again on a second signal. If they get stopped out a second time, do not take the third signal. Just take a break for a little while and see what's going on. If your second entry fails, then you're probably doing the wrong thing. You're probably thinking the market's in a trading range, and in fact, the market may be in a trend. Double top bear flag, reasonable to sell with the stop below that little bear bar. You get filled here, looking for a small trade down. Can you put your stop here, or should you put your stop here? This is a major high. This is a minor high. This is a minor high. Both are okay. If a trader took this sell for this double top bear flag and he held for a swing down and he got stopped out by using a tight stop, he could sell again below a bear bar on the failed breakout. If a trader used a wide stop, he's not going to get stopped out. He would capture this swing down. He would not get out here. Tight stop, wide stop, it does not matter which you choose. Both are reasonable, and as long as you use reasonable stops, if you take the same trade 10 times with a tight stop, you'll have the same amount of profit as another trader who took the same trade 10 times with a wide stop. The wide stop trader loses less often, In other words, he has a higher probability of making money, but when he does lose, his losses are bigger. If you get stopped up using a tight stop and the market reverses down again, you can always sell again. Another double top here or here. If you want, you can call it a triangle. 3 legs up, 1, pull back 2, pull back 3. Does not look like a triangle, but you can call it a triangle if you want. A horizontal trading range with 3 legs up. Let's say you're making money selling above highs. You sell at this high, you made money. It went above, it came down. You sell with a limit order at this high, you made a scalp. And let's say you sell with a limit order at this high. Instead of churning down, it went up. This is never a problem for beginners because beginners should not be selling with limit orders and scaling in. However, if you're an experienced trader, you know how to handle it. You sell at that high, going to use some kind of a measured move up and a wide stop, and you look to sell more higher, expecting the market to come back below the breakout point, and that will allow you to get out break even on your first buy and with a profit with your higher entry. How high up should you put your stop? If you don't see any obvious nearby resistance, using a measured move up is reasonable. The bulls want this to be a breakout that leads to a measured move up. It's a trading range, and therefore it's probably not going to be a breakout leading to a measured move up. And if you use a stop just above a measured move up, it's probably not going to get hit. This high went 4 ticks above that high. Minimum scalp is 4 ticks. A trader selling at this high might scale in 4 ticks above, knowing that the breakout here went 4 ticks above. Maybe this one will only go 4 ticks above. This one went more than 4 ticks above, maybe 8 ticks, I don't know. But in any case, bears are confident that if we do get above this high, it's probably not going much above the high before it pulls back below the breakout point. Instead of selling this high and selling more 4 ticks higher, many bears who sold at this high and got filled here will sell more on a reversal down below a bear bar, as long as the second entry is at least the size of a scalp above the first. Usually, I'll only take that stop entry sell if the second entry is at least 2 or 3 times the size of a minimum scalp, so 2 or 3 points higher. If you scale in either way, a lot of traders will get out break even at their first entry, which is at this high they sold right here, and then with a profit on their second higher entry. Bears are looking to sell above a prior high in the top half of the range. This is a very strong reversal up. If you see this forming, you're not going to be placing a limit order to sell at that high because the odds are too great. This will be a double bottom or a wedge bull flag and the start of a bull trend. However, when you get a strong rally like this and the context is good, wedge bull flag, double bottom, high or low, the probability favors higher prices, so it's usually not good to place a limit order to sell at this high when you see the market going up so quickly. We have a double bottom, a break below the double bottom, and a reversal up, and therefore it's a type of a wedge bottom, failed breakout below a double bottom. It's also a higher low. We don't know what the bars to the left look like, but let's say it was a bear trend. This would be a bull breakout, and this would be a higher low major trend reversal. Let's say you wanted to bet on a second leg trap. You're betting that leg 1 is a wedge, and that leg 2 will be a strong breakout attempt that will fail. And if you're willing to use a wide stop and trade small, you could place a limit order to sell at that high, and you would get filled right here. For a stop, you want to use a stop a little bit more than a measured move up. This is a double bottom here or here. This is the neckline. The measured move up is here, and you put the stop just a little bit above, thinking that the bulls are betting it's going to be a breakout and the start of a bull trend and that it will reach a measured move. You're betting that the rally will be a second leg trap in a trading range, in which case it should not reach the target that the bull trend traders need. You're betting it's a trading range, not a trend. A good way to scale in a situation like this is wait for a bear bar closing on or near its low, and then sell more on a stop just below its low, and then plan on getting out break even at the first entry price, and then with a profit on your higher entry price. This is the end of the session, did not get down to your first entry. It's reasonable to exit at the end of the session. You'd have a small loss here and a bigger profit here. The reason traders scale in is to increase the probability of making money, or to reduce the size or the probability of losing. So if you enter a trade and it turns out to be bad, and you do not want to exit with a loss, some traders will scale in to avoid the loss. Some traders, when they take an entry that they think is reasonable and then conclude that the trade is bad, they will scale in not to make a profit, but to avoid a loss. A trader taking this sell, he might start thinking that maybe this is going to be a bull leg in a trading range instead of a second leg trap. He's therefore not so much thinking about making a profit as he is about trying to avoid a loss. Most traders never plan to let a wide stop get hit, and a lot of traders, when they see the breakout bar and a follow-through bar, they'll just get out at the market, knowing that a lot of other traders will buy at that close, betting on at least a little bit more up. So you take your short here, you see a decent-sized bull bar closing on its high, so a good breakout bar, and then the follow-through bar, even though it has a big tail on top, it has a bull body. The odds are we're going up at least a little bit more. A lot of the bears who sold this high would just take the loss right here. Other traders would bet that the rally, as strong as it is still more likely a bull leg in a trading range than the start of a bear trend, and they will therefore rely on their stop just above the measured move. This is a terrible situation for a scale-in trader. However, it was reasonable to take the short, and if a trader uses a wide stop and manages his trade appropriately, he has an 80% chance of getting out at least break even. In other words, avoiding a loss. The best way to avoid a loss in a trade like that is to look for a bear bar closing near its low and then sell more below that bear bar. You have an 80% chance that the market's going to come at least midway between your first sell and your second sell, and that would allow you to get out break even on the trade. It might even come back to your first entry, and then you could get out break even on your first and with a profit on your second. You could decide that the breakout is so strong, you're so disappointed that you'll be happy just to get out break even, in which case you sell here, you sell more on a stop below that bear bar, you exit break even at the midpoint between your two entries. A loss here, a profit here, and they cancel each other out. The alternative is to hold just in case we reverse down below the breakout point here, allowing you to get out break even on your first entry and with a profit on your second. Here, it did not quite get there, and you just exit at the end of the day with a small profit. A small loss here, a bigger win there. The reason why a lot of traders like to use wide stops is because it gives them time to make decisions, and it increases the probability of making a profit. The reason why you always have a stop in the market is because of black swans. If you lived in England a couple hundred years ago, every swan you saw was white, and you would assume that black swans do not exist. However, if you were a world traveler, you'd find out in New Zealand and Australia, there are a lot of black swans. So things that you think cannot happen can happen. And because you do not think the market can break into a bull trend, that's not reason enough to hold forever. You always need to stop because this could do a low probability thing and just keep going up and up and up. And you need some stop to contain your loss. Now, is a trader going to let that stop get hit? Probably not. Most traders who use wide stops are using wide stops to give themselves time to make decisions and to manage the trade, to scale in to avoid a loss. They're never going to let that stop get hit. Sometimes it will, but they're almost always going to get out before it's hit. That stop is just to protect yourself against something unusual and unexpected, and you don't intend on letting it get hit. So let's say the market's going up here and you do not have a stop, and you get a phone call from somebody and you have to run out in an emergency for some medical problem. If you didn't have a stop and you didn't exit and you rushed out the door, the market could keep going up and you get a huge loss. Let's say your computer crashed, or your electricity went out, or your phone died, or some other unexpected thing, or your broker was having a technical problem. You need some stop in the market to protect against very low probability events, because those low probability events happen and they can cause huge losses. I began by talking about second leg traps. When the market's in a trading range, it often has a second leg up or down that looks especially strong, and it looks like the market is converting from a trading range into a trend. But my 80% rule, 80% of strong breakout attempts in trading ranges will fail, and therefore you have a higher probability of making money betting that breakouts will fail, looking to buy a reversal up from the bottom or sell a reversal down from the top. If a leg up is very strong, it's usually better to wait to enter on a second entry, like a micro double top. If a leg down is very strong, it's usually better to enter with a second entry buy, like a micro double bottom. And beginners should be entering with stops. Experienced traders will often use wide stops and scale in, and they'll often enter with limit orders. But that's only skilled, consistently profitable traders. Beginners should only enter with stops. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading in trading ranges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading in trading ranges. I'm going to begin by talking about how more experienced traders will enter with limit orders, how everyone should take profits. Trading ranges often test the open of the day later in the day. I want to talk about those tests. Trading ranges are often very tight. Most traders should not trade when the market is in a very tight range, but experienced traders often will enter with limit orders and scalp. Every trading range eventually ends and breaks into a trend. In general, in a trading range, you want to buy low, sell high, and scalp. Bulls are going to be looking for buy setups in the lower half, and bears will look to sell in the upper half. One popular way for traders to trade is enter with limit orders. When the market is in the lower half, they'll buy with limit orders at a prior low, and they're willing to scale in lower, and then they'll scalp. Here's another prior low. They'll buy with a limit order there, and here is a low, a minor low, but traders bought with a limit order there, especially since it's a potential micro double bottom in the bottom half of a trading range. Unfortunately, sometimes the stop is far away, but you have to use a stop that is reasonable. For example, putting a stop below the bottom of this 3-legged rally is a reasonable stop. And if you get stopped out, you can buy again on a reversal back up. Another alternative is we have a strong breakout here and we reverse down. Theoretically, the bulls wanted to get a double bottom here, and instead the market's selling off. The bears want to get a measured move down. And therefore, putting a stop just below a measured move down is another logical stop. Some bulls will buy, rely on the wide stop, and buy more lower, hoping to get a test back up near the top of the range. If you are going to be entering with limit orders and scaling in, you have to trade smaller because you want to maintain your risk. You don't want the risk on any trade to be bigger than on any other trade. The reason why traders scale in is because it makes it more likely that they can make money. However, it requires a wide stop and it requires management. Both of those things can create anxiety when a trader is starting out. This is the kind of trade that only an experienced, consistently profitable trader should consider. Whenever you increase your position size, you increase your risk. However, you should always trade small enough so that your risk is no bigger than on any other trade. The minimum scalp in the E-mini is 1 point. If you're looking to scale in, you usually want to be scaling in at least 1 or 2 points below your original entry. An alternative to buying 1 point below is buying with a limit order at a prior low, as long as the second entry is at least as big as a scalp below the first. In the E-mini, the minimum scalp is 1 point, and therefore, if you do not take the second entry 1 point down from the first, and instead you look to buy at a prior low, you make sure that the second entry is at least the size of a scalp below the first entry. An alternative is you can buy a reversal up above a bull bar. This is a small bull bar, and it's also a second entry, first entry above this bar, and then second entry here. That's a higher probability buy. Is it less than a point below the first? It can be, and some traders will take it if they're trading small enough. This is a high probability buy. It's a wedge bottom, reversal up, reversal up, reversal up, and it's a second entry buy. Most traders will only add on to a trade once. So they buy once, and then they take one of these additional buys. So they'll take 2 entries. Some traders will add on a second or third time. So they add on here, and then again 1 point lower, again 1 point lower still. If you're taking multiple entries, always make sure that your entries are small enough so that the entire risk that you're exposing yourself to is no greater than on any other trade. I want to talk a little bit about taking profits. It's always mathematically okay to exit any trade at 2 times your actual risk. You want to make sure that the profit that you're taking is always at least as big as the minimum scalp size. So if 2 times your actual risk is less than 1 point in the E-mini, do not exit at 2 times actual risk. Make sure to exit at least at 1 point profit. 2 times actual risk is the minimum needed to make the trader's equation profitable. But just because it's the minimum acceptable to have a mathematically valid approach to trading does not mean it's the optimum. The minimum is rarely the best choice for anything in life. Working at the minimum wage is not a good choice. Let's say you bought above this reversal bar. You got a small wedge, 1, 2, 3, bigger wedge, 1, 2, 3, a micro double bottom, you have a bull body. That's a pretty good entry. If you bought above this bar, at this point you know that your actual risk was 1 tick below this bar. Therefore, 1 times actual risk is right there. However, it did not reach your original entry. Just because it's a high probability trade and exiting at 1 times actual risk is a reasonable thing to do does not mean it's the best thing to do. Remember, when you're scaling in, you usually want to exit at least at your original entry price or higher. That way there you get out break even on your first buy and then with a profit on your second buy. So a trader who did buy more here could get out there at his original entry price at that low. He bought at that low. It's back 1 tick above that low. That would allow him to get out break even on his first entry and with a profit on his second entry. It's a high probability buy since it's a second entry buy and a wedge, nested wedge. Exiting greater than 1 times actual risk is mathematically good. So this is a reasonable thing to do. Look at the size of the legs up and down. The swings are pretty big. Therefore, exiting with 1 point profit is not necessarily the best choice. Another alternative is to enter with 2 times actual risk. That's always a good decision. It's still relatively small given the size of these legs up and down. Another choice is a trader might exit at 1 times actual risk based upon his first buy. He buys here, the market went down here. Once it reverses up, he knows that he actually had to risk to one tick below the low of this bar. A measured move up from the low of that bar to his entry price is there, and you can see there was some profit taking there. If you want, you can try holding for 2 times actual risk, which is also at the top of the most recent leg down. Since the market keeps reversing at new highs, that is a logical place to sell. Bears will start selling there, so bulls should be taking partial profits there, partial or full profits. Is it a scalp if you get out up here? No, it's a swing trade. It's 4 points. You've sat through pullbacks here and here. It lasted about 10 bars. If you want, you can call it a scalp, but I would call that a swing. You put it on as a scalp and went up strongly enough, some traders will hold part of the trade all the way up until the market reversed and it went up far enough to call it a swing, even though you took it initially as a scalp. When the legs up and down are big like this, lasting 10, 20, or 30 bars up and down, covering a lot of points, traders can swing part of their position or all of their position because there's enough profit for them to make a swing up. At this point, we have 9 bars in a very tight bull channel with no bear bars. The odds are traders will buy the first bear bar and the first reversal down, and the market will go higher. The market's clearly always in long. Somewhere in here before you get to 9 bull bars. That means the market is likely to go higher. Since the market has been mostly sideways, it's also in a broad bull channel. We have a higher high and we have higher low. Traders like to take profits at a prior high, whether it's a trading range or a broad bull channel. In this case, it's also an expanding triangle and a micro double top. That increases the chances that we'll get a deep pullback. And therefore, if you're trading in a trading range, you want to make sure that you're exiting. You want to sell high to take profits on longs, and bears will sell high looking for a trade down. 3 pushes up, 1 pullback, 2 pullback, 3, and therefore it's also a wedge channel, even though it does not have a wedge shape. That is another reason to take profits up there. A bear bar closing on its low, if you did not take profits with the limit order there, it's reasonable to take profits with a stop 1 tick below that bear inside bar. Bears will start to sell there. Trading range days often test the open of the day, late in the day, after 11 o'clock in the final couple of hours, especially if the open of the day is in the middle third of the day. Here's the daily chart. You can see it's sideways with lots of reversals every 2, 3, 4 bars, and a lot of bars close near the open. All of these pink boxes highlight bars that are closing near the open. When the daily chart is in a trading range, the 5-minute chart will have a lot of trading range price action. There'll be some trend days like here, but they'll usually reverse within a day or two. This is a 5-minute daily chart. Strong leg up, but strong leg down. Strong leg up, strong leg down. When the market is near the high late in the day, you have to be prepared to sell because a lot of times it'll try to get all the way back down to the open. Look at all of these days that are highlighted in pink. At least half of the days ended up closing near the open. That means that if the market is far above the open, you have to expect a reversal down. If it's far below the open, late in the day, you have to be looking for a reversal up. And therefore, if you have a second entry sell, especially with a decent sell signal bar, it's a reasonable sell, expecting the market to try to get down near the open, like it did during the majority of days over the past several weeks. The close just above the open, that means the body is small, the tail on top is big on the daily chart. The result is this trading range day is another doji day on the daily chart, like all of these days highlighted in pink. I mentioned earlier that when you get a late reversal back toward the open, it's more common if the open is in the middle third of the day. And you can see a lot of these days that are highlighted have a tail on top and on the bottom, but a small body, and the body is in the middle third of the day. Several days, 5-minute chart. I want to make the point that if you're trading with limit orders, buying below things in the bottom half, selling above things like prior highs in the top half, the market is very forgiving of limit order traders. In other words, you usually can make a profit and you can almost always avoid a loss if you manage your trade correctly. When I say manage your trade correctly, what I'm talking about is if you can use an appropriately wide stop, and especially if you can scale in. Even if you sell the absolute low in a trading range, if you manage your trade correctly, you usually can avoid a loss. When you look at this, you can say, well, how can I possibly avoid losing if I sold here? Well, if you manage your trade correctly, you usually can. You could sell more at about a 50% pullback of the last leg down or on a reversal down, and then exit at the midpoint between your two sells. You sold here, you sold more here or here. This is your average entry price. The market went below it, and therefore you could exit, break even on the trade. You lose some on this, and you make the same amount on that, and you end up getting out without a loss. And that's selling even at the extreme lowest price of the entire trading range. Even if you happen to buy the highest price, you can usually avoid a loss if you scale in and use wide stops. For example, you could buy that high price and then place a limit order to buy more at a 50% pullback of this rally, or on a reversal up, especially since it's a high 2, high 1, pullback high 2, and a bull bar closing on its high. Strong enough rally so that we're probably going to test this high. You could hold and try to get out break even at that high. So you get out break even on your first buy right here and a profit on your lower buy. And you can see the market selling off at that high because bulls who bought lower are selling here. The ones who bought up here are getting out break even. The ones who bought lower are starting to take partial profits. And the bears are selling as well. Tight trading ranges, most traders should not trade them, but experienced traders will. A trading range is a horizontal channel, and channels can be broad or tight. This is an example of an extremely tight trading range here. When the channel is fairly broad, when the trading range is fairly broad, traders can enter with stop orders, selling below reversals down, buying reversals up, and they can sell at the market as it's going down, they can buy at the market as it's going up, and they can also enter with limit orders, selling at a prior high and buying at a prior low here or below bad bear flags near the bottom. When the range is very tight like this, there's very little profit potential. Most traders should not trade. However, experienced traders will trade with limit orders, selling above bars near the top, buying below bars near the bottom. Often they'll use wide stops, swing stops, and they'll scale in. A tight trading range, it's a limit order market. The range is too tight to make money with stops, and it's usually too tight to make much money even if you're a limit order trader. Most traders feel like it's too much work, too little profit, and it's better to wait. Wait for a broader range like this, or for a breakout into a trend. The minimum scalp in the E-mini is 1 point, 4 ticks. To scalp in a tight range, you usually want most of the bars to be at least as big as a minimum scalp size. So you want most of the bars to be at least 4 ticks tall, and you want the height of the range to be at least 3 times the size of an average bar, or 3 times the height of a minimum scalp. Therefore, you want the range to be at least 3 points tall. Can you make money in a range that's only 2 points tall? Yes, but it takes a lot of work, and a lot of times you have to wait through a lot of bars just to make 1 point, and you have to scale in, and it's not much fun. Most traders should not be trading at all when the range is this tight, but some experienced traders will. When it's very, very tight like this, Most traders do not trade. They just let the computers trade. There's a lot of trading taking place. If you look at the volume of these bars, a lot of the bars have 5,000 contracts being traded. So the computers are trading. But if you're an individual trader trading your own account in a discretionary way, I think when it's that tight, it's not worth trading, especially late in the day. You're tired, not much time left to use wide stops and scale in. If you're going to be trading, you want to be selling with limit orders in the top half, and you're going to be scalping. So for example, here's a high one bull flag, but the market sold off at this price level several times. Therefore, you can sell at the high of that bar and scale in higher. Here's another high one bull flag. Some traders will place a limit order to sell at the high of that bar and get filled here, and then take profit here. If you're a bull, you want to be buying below bear flags near the bottom. Here's a low 2 bear flag in the bottom half of the tight trading range. Some bulls will buy with a limit order below that bear bar or at the prior low, at this low, and then they'll scalp out for 1 point. Sometimes you'll get a small bull bar in the bottom of the trading range and you can buy with a stop and then scalp out. And if you're buying low enough, sometimes you can even make 2 points. But would I swing trade this? I would not. The range is very, very tight here, unlikely to lead to a bull trend. If it does start to break strongly into a bull trend, then I'll start buying and swing trading. But until then, I'm going to assume the tight trading range will continue, and every time it goes up, it's going to go down. Every time it goes down, it's going to go up. I'm going to scalp, take quick profits. The trading range is a limit order market, and you trade it like any limit order market. The bulls buy bear strength in the bottom half. So in other words, when they see a big bear bar, they're starting to look to buy. And the bears sell strong bull strength in the top half. So when they see big bull trend bars in the top half, the bears start looking to sell. And both take profits somewhere in the middle third. A lot of experienced traders will scale in, scalp, and use wide stops. A strong bull close near the top of a developing range, bears sell. They'll sell it. They'll sell it, bidding against a successful breakout. They'll sell at a prior high. The market reversed down here. Bears will place a limit order to sell at that prior high. A prior high here, they'll sell there. It's in the upper half of the range. Some bears would sell at this high as well. To me, I think it's probably too low in the range. I'd rather be selling as close to the top of the range as I can. Some bears will sell at a prior high and they'll scale in higher, 1 point higher or 2 points higher. Or they'll sell on a reversal down, below a bear bar. We have a bull flag, but it's near the top of a developing trading range, and the buy signal bar has a tail on top, not a particularly strong buy. Some bears will place a limit order to sell at the high of that bar, betting that it's a bad bull flag and that we will reverse down far enough for them to make a 1 point scalp. Bulls will look to buy at prior lows in the bottom half of the range. Here's a prior low. The bears are trying to get a reversal. It's a trading range. Bulls will bet the bear breakout will fail, so they'll place a limit order to buy at that low, and then they'll scalp out. And the same is true here. They'll buy at that low and scalp out on a bounce up. A prior low here, they'll buy at that low. Many will also scale in lower, so they'll buy at that low and they'll buy more 1 point lower, expecting the market to go back above the breakout point. That would allow them to get out break even on their first entry, and with the scalper's profit, a 1 point profit on their lower entry. Some traders prefer to buy on a reversal up, a decent bull body, and it's a wedge, 1, 2, 3, and then buying above this bar, it's a micro double bottom, a second failed breakout below this low. Buying above this bar, it's a higher probability buy. Whenever you see a big bear bar closing near its low in the bottom of the range, bulls will buy the close, betting that the bear breakout attempt will fail, like here and here. A bear flag at the bottom of the range. We have a bear breakout to a new low, and we have a pullback, so a low one bear flag, but 2 bull bars, and the sell signal bar, this bar, has a bull body and a tail on the bottom. It's a low probability sell. Bulls will place a limit order to buy at that low. all trading ranges eventually break out into trends. Trading range, so traders are looking to buy low, sell high, and scalp until there's a strong breakout up or down with good follow through. They'll bet that every breakout will reverse. The bulls have a breakout, so guess what the bears are going to do? They're going to sell it, betting that the bulls will not get consecutive bull bars. They'll also sell on a reversal down, especially micro double top. Bulls will buy this low, betting that the breakout below this range will fail and that it will be a wedge bull flag. Bull trend, wedge, 1, 2, 3, 4, and they'll buy more lower. We have two big bear bars. We have a third big bear bar here. If you bought there or here, what are you going to do? For me, when I see consecutive bear bars here and here closing on their lows and breaking below a trading range, I'm assuming we're going to get a measured move down, that it will be a measuring gap. Therefore, bulls who bought this low, and if they had a limit order to buy more lower, and they get filled here, by the close of this bar, they're going to say, uh-oh, consecutive big bear bars breaking below the bottom of the range. We're getting a bear breakout below a bull flag, and we have consecutive bear bars closing on their lows. The next bar here does not have a bull body. This is probably going to lead to a measured move down. And when that happens, you just sell out of your longs at the market. Don't try to get a better price. You just sell out at the market. The market's telling you that you're wrong. And whenever you're wrong, it's always better to get out immediately than hope to be able to get out a little less wrong. The bulls are giving up. That's what these two bars represent. And the bears know that the bulls are giving up, and therefore the bears are selling, betting on a trend down and a measured move down. And they'll sell for any reason. They'll sell the close of bear bars. They'll sell a bull reversal up, betting that there'll be resumption of the bear trend and the bull reversal will fail. They'll sell below bars. If you're a bull and you're looking to buy with a limit order at the bottom of a bear channel, hoping that you're buying at the bottom of a trading range, you can only take that limit order buy if you're able to get out when you decide that you're wrong. You don't want to decide down here that you're wrong. You want to decide by the close of this bar or the close of the next bar that you're wrong, and you just take your exit. You lose about a point here, and you get out around break even on your second entry. This is difficult for beginners to do. They see this very strong trend. They see this as a bull flag in this strong trend, and they're in denial as the market's breaking to the downside. It can cost you a lot of money if you're unable to get out quickly. And that's another reason why only experienced traders should be trading with limit orders, buying at the bottom of a trading range, because sometimes the trading range becomes a bear trend, as it did here, even if there was a very strong rally initially. Sometimes a breakout does not look all that strong, yet it continues up relentlessly. The market's in a trading range, 50% chance that you'll get a bear breakout. We have a double top bear flag. 50% chance we'll get a bull breakout, a higher or low major trend reversal, and a head and shoulders bottom, left shoulder, head, right shoulder. 50% chance the first breakout, up or down, will fail and reverse. If at some point you decide that it's becoming a trend, stop trading it like a trading range. You have to trade it like a trend. Sometimes the breakout can be one huge bar or two medium-sized bars. Other times it's just a series of small bull bars with very small pullbacks, a very tight bull channel. On a higher time frame chart, this is a very strong breakout. And therefore, if you see a relentless, very tight channel lasting a lot of bars here, it's about a 7, 8, 9 bar bull micro channel. The market is breaking out and the bears have to get out of shorts, even though we're at the top of a trading range. I talk more about breakouts that are made of very small bars but lasting a lot of bars in the videos on trading breakouts. Higher low major trend reversal, head and shoulders bottom. "21 bars in an extremely tight bull channel, and 10 of those bars, no pullback for 10 bars, a 10 bar bull micro channel. Even though the market lacks big consecutive bull bars, this is a trend based on time more than price. The bulls are owning a lot of bars. The bulls are in control for a lot of bars, even though they're not getting a big breakout. On a higher time frame chart, this is a strong breakout. Traders have to begin to trade it like a trend and stop trading it like a trading range. Experienced traders will enter with limit orders and trading ranges, buying near the bottom, selling near the top. When you're taking profits, you have to be scalping for the most part. If the legs up and down are big enough to swing trade, you can swing trade part of your trade, but I would not bet on a successful breakout because of my 80% rule. 80% of breakout attempts will fail. If the market has had a lot of trading range days lately, today is probably going to be a trading range day. And therefore, if the market is far above the open late in the day, be prepared to sell a reversal down back toward the open. If the market is far below the open late in the day, look to buy a reversal up, especially a second entry buy, and especially if the open is in the middle third of the day's range. When the market's in a very tight trading range, most traders should not trade, but experienced traders will sometimes trade with limit orders using wide stops and scaling in. Even though my 80% rule says that 80% of breakout attempts will fail, eventually there will be a successful breakout. When the market begins to trend, stop trading it like a trading range. Accept what's going on and begin to trade it appropriately. Begin to trade it like a breakout. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading in trading ranges.